Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, our guest is Stephen Speer, who is the founder and CEO of eCommerce Lending. Welcome, Stephen.
Thanks for having me, Gary.
So, Stephen, what got you into lending? Kind of tell us your backstory.
I've always been fascinated by finance, and when I graduated from college, I gravitated towards finance straight out of the gate, and been in it a very long time. By the color of my facial hair, you could probably tell I'm not just a recent graduate. Right. But most importantly, about a dozen years ago, I fell more into the business acquisition segment, especially the fact that a lot of baby boomers are retiring right now. So I saw a lot of opportunity within that segment. Not only a lot of baby boomers retiring, but the vastly growing e-commerce space also had me gravitate towards providing financing for business acquisitions.
Right. So I guess when people are going to purchase additional business or new businesses and so forth, kind of what should they be looking for in a lender when they're going to do this?
That's a really good question, Gary. So what I will say is that sometimes people that are looking to acquire businesses go at it kind of the wrong way. They think it's like buying a house or something, and it's vastly different than that. It's far more complex. And for many different reasons, ultimately when you are looking for finance for business acquisition, it's not just the business part needs to qualify for financing, but also the buyer needs to qualify. Whereas if you're buying a home, just the buyer needs to qualify. It's a lot simpler situation. So, but in terms of the business, we look for the fact that business has adequate cash flow to meet the debt service requirement of the said business. We look at that on one side. And the other side, we look at the business acumen of a buyer. We look at the personal liquidity of a buyer to make sure that that person is going to be the right steward of the business post-acquisition. So that's what we look for. Right.
Now, how much coaching do you guys end up doing kind of through this process? Because I know from the tax and accounting side, I've talked to people many times and they've had like, okay, this business is not going to give you the ROI that you want in the short period of time that you want it to kind of pay itself off type thing. I mean, do you guys get more into that?
We very much take a consultative advisory approach with our clients, especially if it's their first time acquiring a business. So we definitely dive deep in terms of overall, in terms of what the type of business they're looking to acquire. Sometimes they already have one in mind, sometimes they don't, but they come to us generally very early, Gary, in having us advise them, which ultimately leads to them going under contract for a business.
Right. Now, when you guys are lending to business owners or potential business owners, kind of what are the terms, like length of time, not so much your rates, but length of time?
Well, it depends if it's a lower market or the lower middle market. So we finance both segments. So the lower market would be deals typically up to $6 or $7 million.
Okay.
And then the lower middle markets would be deals typically $7 million and up. We have deals that are for $1 million that we're working on. Right now, we have a deal for $140 million. So it just depends on the two segments. Mm-hmm. But on the smaller segment, the lower market, meaning roughly a $6 million acquisition or less, generally that's SBA financing through the SBA 7A program. Right. And those terms are 10 years. Mostly all the lenders offer the same rate. It's not where like house shopping or mortgage shopping where, every lender is different. It's just pretty much, it's a 10-year loan. Right now it's at 11.25%. And it's straight line amortization, and that's what it is.
Okay.
Yeah.
I think a lot of people, you just said, right, currently it's 11%. A lot of people are probably, oh my God, that's high. Kind of talk a little bit about that, because I mean, the business rates are way different than housing rates.
Well, I mean, ultimately housing rates, they're what, 8% now. I mean, basically the days of 2% interest are over for right now. So yeah, many people are shocked by, oh my God, 11%. But ultimately, lenders are lending on an acquisition. Generally, lenders are lending on an asset-light business. There's really no there. So whereas when you're buying a house, rates are by default going to be less because you have the house as collateral. Whereas with SBA financing on asset-light businesses, there's really no assets. You're lending. The lender is lending based on the cash flow of the business. So there's greater risk there. So obviously the rate's going to reflect that.
Right.
Yeah.
I guess, are there, and you guys may not do it, but I mean, do you guys go even lower? I know you're saying, hey, that one is, 6 million and down. I mean, so are you guys doing loans, because I know SBA, I think will do some down to like 100 grand or whatever. Are you guys doing loans that low, or are you, really trying to stay above $1 million, or what do you do?
We're from about 500,000 up to stratospheric levels, basically. So SBA 7A loans generally are $350,000 or greater. Below that, it's very hard to find financing. And most people acquiring businesses for less than a couple of 100,000 generally are paying cash anyway.
Right.
So yeah. And back to the rate thing. So yeah, rates have increased drastically in the last 2.5 years, roughly. But also multiples, meaning the multiples of businesses have come down proportionately. So the rates really haven't impacted the acquisition market very much at all because of those things. Multiples are coming back down because obviously less competition for acquiring those businesses. Plus the rates are higher, which, ultimately if the rates are higher, the debt service of that business is higher. So the numbers have to work proportionately. And that's why we've seen purchase prices of businesses come down, especially during the last 18 months.
Yeah. Because I can remember hearing, people talking about getting 8, 9, 10 times EBITDA on some of this stuff. And it's like,
Yeah.
and recent years, it seems like it's that I've heard
Back down.
it's more like, 4, 5, 6 times.
Yeah, it's come down quite a bit. And you're right, just a mere 2.5 years ago, we're seeing 8, 9 times EBITDA, like you mentioned. And now for the most part, 5, 5.5. So it's really come down quite a bit.
Right.
So, and rates will eventually come down. It's just right now the rates are at historic highs.
Right. And going through, what you guys do, because I know, I mean, obviously lots of times people don't want to put their own cash in because they want to be able to save that. With the wealth accumulation that people try to do, how much that plays into, it may not be part of the business, but looking at it from the buyer and stuff like that. I mean, how much of that comes into play with you guys?
In terms of somebody's personal liquidity, is that what I'm understanding?
Yeah.
That definitely comes into play on many different levels. So we obviously our clients, either not, maybe not them directly, but they're generally, our clients have partnerships, like typically 2 or 3 people, generally, not always, but generally. So we look for those partners to have personal skin in the game. So generally on these deals, at least 5% of injection or down payment.
Right.
And also we look for post-closing liquidity, because ultimately when we finance somebody, we want to make sure that the business has enough liquidity to continue its growth post-acquisition. We want to set our clients up for success. And if they don't have the ability of putting more money into the business and growing it, then it really stifles growth. So that's one thing that we definitely look at, because we ultimately want to have that business accumulate wealth for our clients, not just to buy a business, but to actually have some sort of exit at the end of the day for a lot more money. So it is a good growth, good wealth creation vehicle, as other things are as well. But especially with all the baby boomers retiring, it's a lot of our clients are even first timers buying businesses because of that. But we try to keep our clients as liquid as possible by having them put in as least amount of money into a deal and structuring the deal accordingly. So anyway, hopefully that helps.
So yeah, so again, going back to that, you guys help counsel people with this too. So if you think that somebody is putting too much cash in up front, do you talk to them about, hey, maybe you should hold some of that back, type thing?
We do. The biggest, I've been doing this a very long time. I've been in lending nearly 30 years. And I think the biggest challenge for business owners is having cash on hand, meaning being able to use cash that they have to grow their businesses. And it's really hard. One thing I want to share with your audience, it's really hard, Gary, for business acquirers or business people to establish, let's say, a line of credit or cash post-acquisition. I always encourage our clients to do it pre-acquisition, because once it's post-acquisition, their entity that bought that business that they were acquiring is new, and it's impossible to get financing, let's say working capital for that business. We always try to have our clients put as least amount of their own capital into deals. With the one caveat, like obviously we don't want them to be having their entire net or entire profit go towards debt service. So there is a happy medium, but we've had clients go, hey, I want to put 50% in this and that, and they're left with nothing post closing. And we're like, no, we don't recommend that. Put 20% in, keep the other 30 on the sidelines. You need dry powder to continue growing this business. You'll thank me for it later. And sure enough, most of the time they thank us, and we didn't have them.
I think what lots of times people lose sight of is they think of, oh, I put together my budget, I have my business plan, this is what I'm going to do. But there's tax, there's budget, profit and loss, but then there's cash flow. And you could have a very profitable business, but your cash flow can suck because all your money's out on the street in receivables. So it's important to understand that cash flow cycle, when you go into something like this.
Oh, absolutely.
What are some of the industries that you guys are involved with lending, or does it make a difference?
Wow. We're very much agnostic in that segment, but just to kind of give you a flavor, tech-enabled businesses, educational technology businesses is really something that we like to focus on. It could be, both, we're kind of, despite our name, e-commerce lending, we work within not only e-commerce segment, but we also work in traditional businesses as well. We finance those as well, because a lot of times, Gary, our clients are looking at both types of opportunities. So HVAC companies, I think, are very prominent. A construction company right now we're working on. And then Amazon businesses. That's another thing. Amazon resellers. We do a lot of those. So really very broad. Some of the industries that we're not keen on would be probably consumer product businesses, unless those businesses have some sort of secret sauce or some proprietary whatever, some private label angles on those. But that kind of gives you a flavor of what we're currently working on.
I mean, from the lending standpoint, is there a difference? Are you seeing a difference in the e-commerce side versus, I'm going to call it, the brick and mortar side?
A difference regarding financing or a difference in regarding opportunities?
Opportunities.
I think just in general, there are more online or e-commerce SaaS opportunities in general than there are brick and mortar.
Mhm.
Also on the brick and mortar side, Gary, you know, it's often tied to geographic restrictions. So that
Right.
you're there in Virginia, correct?
Maryland.
Or Maryland, sorry, Maryland, you're kind of limited to something within your backyard. Whereas
Right.
e-commerce, we have sellers in California and buyers in New York. It doesn't matter.
Right.
There are no geographic limitations. But there are a lot of brick and mortar opportunities out there. You have a lot of baby boomers. Back to my earlier point, you have a lot of baby boomers that are retiring, and they're perhaps their next of kin aren't interested in continuing forward with the family business, and they're selling. And we've had a lot of clients find those opportunities within their local communities.
Right. Now, what about, I mean, do you guys do lending for somebody who may be more the brick and mortar now, but are transitioning over to more the e-commerce side?
Yeah, yes. Yeah, recently financed a business that was traditional, just absolutely traditional. It was a mobility business. So for elderly people, they get around?
Right.
And they were bringing in the e-commerce segment to that. And just on paper, in terms of a pro forma, we saw 400% growth opportunities post acquisition.
Right.
Yeah.
Now, do you guys, when you're looking at these deals for people and stuff like that, and you're going to do the lending, and I know again, I keep going back to that you guys do counseling with them and stuff. Do you counsel them also on, hey, have you thought about adding an e-commerce branch to this, or do you try not to get into that too much?
Oh, we counsel our clients. So kind of three things we do, just so you know, Gary. We provide financing.
Mhm.
We also provide solo acquisition advisory just by itself.
Okay.
And another moat is that we provide search services. So we also find businesses for people looking for businesses.
Okay.
Most recently, we had a client in the SaaS space looking. He has a SaaS business looking to acquire another SaaS business similar to his, and we found that business, and he is under contract right now to close next month. So that's just one example.
Okay.
Mhm.
That's awesome. Because again, lots of times you have people that have an existing business and they want to grow it. And
Right.
then, I think lots of times they kind of get handcuffed. If they go the traditional route of going to the bank, then at that point, in my opinion, most of the banks, you're just a number and they're not providing any counseling or anything else. They're just checking the box. Do you have this? Do you have this? Do you have this?
Yeah, and that's one reason why I formed e-commerce lending, is that a lot of people were frustrated the way the antiquated banks worked. Also, the fact that they have a dismal track record of loan approval at
Yeah.
most recently 62%. And then we were able to close 100% of our loans last year. And we're on track to do the same thing this year because of all the heavy lifting we do up front
Right.
and provide that one-on-one relationship with our clients.
Right. That's awesome. What have I not asked you that you wish I had?
I think a lot of it is, really having your audience really look at acquisitions for wealth creation, because ultimately all of us have a certain number we need to retire, and that could really propel a lot of people if they buy that $1 million business and in 5 years it's worth 15 million.
Right.
Provide that into provide that windfall at the end of the day, and it's a good way to do that. Some people do it with real estate, some people do it with other investment vehicles as well, but ultimately I really think that, especially what's going on with the baby boomers retiring, there are a lot of opportunities for people in all age types to really take advantage of that.
Right. Hey, I appreciate your time today. I could go on forever because I think I find this part of it fascinating, because I mean, I'm running the numbers on my side for clients and stuff. But lots of times the financing side of it, I think is extremely important. And it's great to hear that you guys provide a lot of the counseling, because I think that that's something, that is needed all the time, with people to be able to get that feedback from somebody that's done this type of thing for 30 plus years.
Right. And I'm sure the same goes with your practice, that you provide a lot of counseling, and that's what separates us, and the ability to provide additional value to our clients. And that's what makes us hopefully successful. So,
Okay.
yeah.
Right. Definitely. Hey, Stephen, I really appreciate your time today. It was great having you on.
Thanks for having me, Gary. I appreciate it.
Great. Hey, this week our guest was Stephen Speer, who is CEO and founder of eCommerce Lending. Thank you, guys, and I'll see you next week.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.